see. We are, well, less than 2 minutes away from RBI Governor Shaktikanta telling us about what the decision has been. The decision will be flashed on the screen. Our ticketing will be giving out to you as soon as we get to know about it. But as Samina has been saying, it's probably not as much about the decision, Samina, as it is about the commentary, about the stance on liquidity and about Paytm.
Indeed. I think Paytm is going to be the bigger question that reporters are going to be asking the governor. But let's not forget that apart from the rate cut, which I don't think anybody is expecting.
Change of stance?
Change of stance, maybe a withdrawal from from restrictive to more of a neutral stance is what the street is slightly divided on. But yeah, the bigger story is going to be liquidity. Let's not forget we had a very critical budget in terms of the macros of the country. So keeping in mind the path of fiscal consolidation, the fact that market borrowing is lower, US Fed is not going to move on this rate cut, on their rate cut anytime soon, and the fact that the liquidity will also ease in the system because of our inclusion in the JPM index, a couple of factors will play out. But I think if you had to put our bets on this, Neeraj, no rate cut, no change in stance, literally just, I don't think there could be much coming in, even though I know the House is divided and that is a little bit of an expectation out there, but unlikely, right? I just can't see why we need a change in stance at this stage. We've seen earnings. I understand there is a little bit of pressure, but you've anyway got the RBI controlling.
But you change the stance so that you set the stage for being able to take an action as and when you want to.
That's when you know Neeraj is an equity man, right? He's literally hoping that there's a change in tone, because a change in tone will fuel the market rally. Take a look. Let's quickly take a look at what Bank Nifty is doing, what some of your PSU banks are doing. I wouldn't imagine too much activity on any of those parameters. Oh, and Bank Nifty is not doing too badly. Maybe they think like Neeraj this morning.
No, just how they started, just how it started. But yeah, you know, bond yields have moved to a different range post-budget. So it'll be interesting to see what happens to yields today. And as Samina mentioned, maybe, who knows, maybe the currency too. Though it's kind of steady.
It's the fighter.
It's the fighter. It's the fighter. Yes. So yeah, all of those things in focus. Okay, I think it's 10, so we should be getting those flashes up on the screen any moment. Should be coming any moment, but I think this is something where we keep a keen eye out for. And as soon as Governor Das starts speaking, I think we cut to him and try and hear out what he has to say.
Also, on liquidity, I think it would be interesting to see how comfortable the RBI is with keeping call rates at 6.5%. Remember, the call rate is higher. Banks will have to raise money from depositors. So the whole equation really starts moving back to the other avenues of the market. They've maintained their liquidity stance. We've seen, various measures taken by the Reserve Bank of India in the form of VRR. In fact, that's going to be important to see if they talk about those measures. Could be FX swaps, could be VRR, but from the look of it, that is going to be the biggest talking point. At least it has been the biggest talking point amongst economists in the last couple of weeks. Core inflation is sub 4% at 3.8%. That is comfortable for the Reserve Bank of India. Be interesting to see what they are charting out for inflation. What sort of growth targets do they have in mind as well? While the NSO has predicted or estimated growth of 7.3% this year and 7% next year,
this is the first monetary policy statement of 2024, a momentous year for the Reserve Bank of India, which enters its 90th year of existence and operations on 1st April this year. Over the years, the Reserve Bank has established itself as a credible institution which stands for stability, trust, and economic progress. In recent years, it has become a pioneer in fostering innovation and technology in the financial system. Customer centricity and financial inclusion have always been its priorities. The Reserve Bank's tireless efforts towards maintaining a fine balance among price stability, financial stability, and external sector stability have paid rich dividends as the country embarks on a higher growth trajectory in the years to come. As India gains a pole position in the new global order, the contribution of the Reserve Bank is getting widely recognized both within and outside the country. The global economy continues to present a mixed picture. On the one hand, the odds of soft landing have increased, with inflation moving closer to the target and growth holding up better than expected in major advanced and emerging market economies. On the other hand, the ongoing wars and conflicts and the emergence of new flashpoints in different parts of the world, with disruptions in the Red Sea being the latest in the series, impart uncertainty to the global macroeconomic outlook. In this unsettled global environment, the Indian economy has performed remarkably well in the recent years. Growth is accelerating and outpacing most of the forecasts, while inflation is on a downward trajectory. At the current juncture, India's potential growth is propelled by structural drivers like improving physical infrastructure, development of world-class digital and payments technology, ease of doing business, enhanced labor force participation, and improved quality of fiscal spending. Our multi-pronged, proactive and calibrated policies on the monetary, regulatory and supervisory fronts have worked well to maintain and strengthen macroeconomic and financial stability. Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, the Monetary Policy Committee, which met on 6th, 7th and 8th of February, that is culminating today. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Monetary Policy Committee, that is MPC, decided by a 5-1 majority to keep the policy rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The momentum in domestic economic activity continues to be strong. Headline inflation, after moderating to 4.9% in October, rose to 5.7% in December 2023. This was primarily due to food inflation, mostly vegetables. The softening in core inflation, that is CPI inflation excluding food and fuel, continued across both goods and services, reflecting the cumulative impact of monetary policy actions as well as the significant softening in commodity prices. The uncertainties in food prices, however, continue to impinge on the trajectory of headline inflation. Taking into account this growth inflation dynamics and the fact that transmission of the cumulative 250 basis points policy rate hike is still underway, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will carefully monitor any signs of generalization of food price pressures which can fritter away the gains in easing of core inflation. Monetary policy must continue to be actively disinflationary to align inflation to the target of 4% on a durable basis. The MPC will remain resolute in this commitment. The MPC also decided to remain focused on withdrawal of accommodation to ensure fuller transmission and anchoring of inflation expectations. I now propose to provide an assessment of growth and inflation. Let me take up first global growth. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. I would like to mention that, I am making several statements, and the supporting data for all the statements that I am making, all the sentences that I am reading out, the supporting data is provided in the footnotes. So therefore, those of you who are interested can refer to the footnotes for the backup data in support of whatever statements I am making here. So let me just restart so that there is continuity. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. Inflation has softened considerably and is expected to moderate further in 2024. Financial markets are volatile as market participants adjust their expectations on the timing and pace of rate cuts by major central banks, who in any case remain cautious against premature easing in their fight against inflation. Amidst the current headwinds, elevated level of public debt is raising serious concerns on macroeconomic stability in many countries. Now, this is a new point which I am just introducing, which I am talking about in this MPC, because this aspect, I think, is an important aspect, and it will impact the future trajectory of global financial stability and global financial system. So therefore, this point I thought I must mention here as a part of the monetary policy statement. Now, amidst the current headwinds, elevated levels of public debt is raising serious concerns on macroeconomic stability in many countries, including some of the advanced economies. Global public debt to GDP ratio is projected to reach 100% by the end of this decade. The public debt levels in advanced economies, in fact, are much higher than those in the emerging market economies. The challenges of debt sustainability in an environment of high interest rates and low growth at the global level can become new sources of stress. Reducing debt burdens is necessary to create fiscal space for new investments in priority areas, including green transition. Now, in this context, so far as India is concerned, going by the budget which has now been presented, I think government is adhering to a path of fiscal consolidation, and as per the projections made by the International Monetary Fund also, India's that is general government, the debt of both central and state governments are expected to moderate in the years to come. This is just a point of information to put things in the context. Domestic growth. Domestic economic activity remains strong. The first advance estimates placed the real gross domestic product, that is real GDP growth, at 7.3% for 2023-24, that is for the current year, making this the third successive year of growth of above 7%. Going forward, the momentum of economic activity witnessed during the current year, that is 23-24, is expected to continue in the next financial year also, that is in 24-25. Agricultural activity is holding up well despite lower inflation, lower reservoir levels and delayed sowing. Rabi sowing has surpassed last year's level as well as the normal acreage. The allied sector is also expected to provide major support to agriculture with continued momentum in horticulture and fisheries. Industrial activity is gaining steam on the back of improving performance of manufacturing. The early results of corporates in the manufacturing sector remain upbeat, driven by higher profit margins. The Purchasing Managers Index, that is PMI for manufacturing, is displaying expansion along with strengthening of Future Activity Index. Services sector activity is expected to remain resilient on the back of strong domestic demand and stable global prospects. The PMI services increased significantly in January, that is January this year, suggesting continuing strong expansion. The buoyant demand for residential housing, coupled with increased thrust on government capex, is expected to propel construction activity. On the demand side, improving employment conditions and moderating inflation, together with a rebound in agricultural activity, should push up household consumption. Rural demand continues to gather pace, strengthening farm-level activity as reflected in declining Mahatma Gandhi Narega demand and the extension of Pradhan Mantri Garib Kalyan Anna Yojana should further support rural consumption. Urban consumption remains strong on the back of improved income levels. Investment cycle is also gaining momentum, is gaining steam, aided by sustained thrust on government capital expenditure, increased capacity utilization, rising flow of resources to the commercial sector, and policy support from schemes such as production-linked incentive. Revival in private corporate investment is also underway. Our survey suggests that investment intentions of private corporates remain upbeat, and both services and manufacturing firms are optimistic about overall business conditions. Next, net external demand is also improving with narrowing merchandise trade deficit. Now, taking into account all these factors into consideration, real GDP growth for 2024-25, that is the next financial year is projected at 7%. I repeat, real GDP growth for 2024-25, that is next financial year, is projected at 7%, with Q1 at 7.2%, Q2 at 6.8%, Q3 at 7%, and Q4 at 6.9%. The risks are evenly balanced. Let me now turn to inflation. Headline inflation moderated to an average of 5.5% during April to December 2023 from 6.7% during the whole of 22-23. Food price inflation, however, continued to impart considerable volatility to the inflation trajectory. In contrast, the deflation in CPI fuel deepened and core inflation moderated to a 4-year low of 3.8% in December. The decline in core inflation continued to be broad-based, with inflation remaining steady or softening across its constituent groups and subgroups. The inflation trajectory going forward would be shaped by the outlook on food inflation, about which there is considerable uncertainty. Adverse weather events remain the primary risk, with implications for the Rabi crop. Increasing geopolitical tensions are also leading to supply chain disruptions and price volatility in key commodities, especially crude oil. On the positive side, the progress in Rabi sowing has been satisfactory and augurs well for the season. Prices of key vegetables, especially onions and tomatoes, are registering seasonal price correction. Taking into account these factors, CPI inflation, that is consumer price headline inflation, is projected at 5.4% for the current year, that is 23-24. So that is for the current year 23-24, we are projecting CPI inflation at 5.4%, with the fourth quarter, that is the current quarter, projection of 5%. Now, assuming a normal monsoon for the next year, CPI inflation for the next financial year 24-25 is projected at 4.5%. I repeat, CPI headline inflation for next financial year 24-25 is projected at 4.5%, with Q1 at 5%, Q2 at 4%, Q3 at 4.6%, and Q4 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions, what do they mean for monetary policy? Let me try and answer. Inflation has seen a significant moderation from the highs of the summer of 22. That is the summer of 2022. Over the last 2 years, monetary policy has prioritized inflation over growth, undertaking calibrated increase in policy repo rate by 250 basis points and withdrawal of stimulus measures. Monetary policy was supported by proactive supply-side measures by the government. That said, the job is not yet finished, and we need to be vigilant about new supply shocks that may undo the progress we have made so far. Headline inflation has remained high and has seen considerable volatility, moving in a range of 4.3% to 7.4% during the current financial year. Recurring food price shocks could interrupt the ongoing disinflation process, with risks that it could lead to de-anchoring of inflation expectations and generalization of the price pressures. Adding to these are the renewed flashpoints on the geopolitical front, including supply chain disruptions. Importantly, the CPI inflation target of 4% is yet to be reached. Monetary policy in the midst of these lingering uncertainties has to remain vigilant to ensure that we successfully navigate the last mile of disinflation. Now, the last mile of disinflation is always the most challenging, and that has to be kept in mind. Stable and low inflation at 4% will provide the necessary bedrock for sustainable economic growth. This point is very important because if we are interested in the long-term growth of our economy, then we need a regime of low and stable inflation. That is why we remain focused on bringing the inflation, to align the inflation to the target on a durable basis. I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system-level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system-level liquidity, I must mention that in the recent, particularly in the second fortnight of January, government expenditure was sustained, but I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And so with government spending picking up and augmenting system-level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity. Financial market segments have adjusted to the evolving liquidity conditions in varying degrees. While the short-term rates have fluctuated, long-term rates have remained relatively stable, reflecting better anchoring of inflation expectations as indicated in the softening of term spread in the government securities market. In the credit market, however, monetary transmission remains incomplete. Let me reiterate, and this is very important, let me reiterate that our policy stance is in terms of interest rate, which is the principal tool of monetary policy in the current framework. Our stance of withdrawal of accommodation should be seen in the context of incomplete transmission and inflation ruling above the target of 4%, and our efforts to bring it back to the target on a durable basis. So far as liquidity conditions are concerned, these are being driven by exogenous factors which are likely to correct in the foreseeable future, aided by our market operations. On our part, the Reserve Bank remains nimble and flexible in its liquidity management through two-way main and fine-tuning operations in both repo and reverse repo. So you would have noticed we have done two-way, market interventions, both repo and now reverse repo. And we have been very nimble even during one particular day, like yesterday and day before. On a single day, we conducted 2 VRR auctions on a single day. That was seen yesterday and day before. And that goes to show that we are nimble and swift in our response to the evolving liquidity conditions. Now, I would like to emphatically state here that we will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner and financial stability is maintained. The reversal of liquidity facilities under both SDF and MSF, even during weekends, which we announced in the last, that is in December policy statement, has actually facilitated better funds management by the banks. As of February 7, 2024, the Indian rupee has remained stable compared to both its emerging market peers and even a few advanced economies. In terms of coefficient of variation, the Indian rupee exhibited the lowest volatility in 2023-24 as per the data available between April to January of the current financial year. Now this I am saying compared to the corresponding period in the previous 3 years. Let me reiterate that the exchange rate of the Indian rupee is market determined. Its relative stability in the recent period, despite a stronger US dollar and elevated US Treasury yields, reflects the strength and stability of the Indian economy, its sound macroeconomic fundamentals, financial stability, and improvements in India's external position, particularly the significant moderation in current account deficit, comfortable foreign exchange reserves, and return of capital flows. Now, the confluence of all these factors put together have ensured that the Indian rupee, the exchange rate of the Indian rupee, has remained fairly stable over the last 1 year or so. I would now like to touch upon financial stability. The domestic financial system remains resilient with healthy balance sheets of banks and financial institutions. The financial parameters of non-banking financial companies, that is NBFCs, are also improving in tandem with those of the banking system. Good governance, robust risk management, sound compliance culture, and protection of customers' interest are of paramount importance for the safety and stability of the financial institutions as well as that of individual financial institutions. The Reserve Bank lays great emphasis on these aspects. We expect the regulated entities of the Reserve Bank to accord the highest priority to these functions. External sector is the next area on which I would like to touch upon. India's current account deficit declined sharply to 1% of GDP in the second quarter of 2023-24, that is second quarter of the current financial year, from 3.8% in the second quarter of the previous year. Going ahead, the net balance under services and remittances is expected to remain in large surplus, partly offsetting the trade deficit. India's services exports remained resilient in October to December this year, driven by software, business and travel services. Moreover, with around 10.2% share in world telecommunications, computer and information services exports, India is a significant player in the world software business. According to the World Bank, with an estimated $135 billion inward remittances in 2024. I repeat, the World Bank estimates the inward remittances for India to be in the order of $135 billion in 2024. Now with this, India would remain the largest recipient of remittances globally. Thus, current account deficit for both 2023-24 and 24-25 is expected to be eminently manageable. On the financing side, net foreign direct investment stood at $13.5 billion in April to November 2023, as compared with $19.8 billion a year ago. Foreign portfolio investment, that is FPI investment, witnessed a sharp turnaround during 2023-24, that is current year, up to February 6, with net FPI inflows of $32.4 billion as against net outflows of $6.7 billion a year ago. Net accretions to non-resident deposits and net inflows under external commercial borrowings were also higher during the current year. As on February 2, 2024, India's foreign exchange reserves stood at $622.5 billion. Vulnerability indicators suggest greater resilience of India's external sector. We are confident of comfortably meeting all our external financing requirements. I shall now announce certain additional measures, and some of these measures are very important, so I request your patience. The first measure I wish to announce is a review of the regulatory framework for electronic trading platforms. The Reserve Bank's extant regulatory framework for electronic trading platforms was issued in 2018. In view of the subsequent developments in markets, products and technology, etc., a revised regulatory framework for these electronic trading platforms will be issued for stakeholders' feedback. The next announcement relates to hedging of gold price risk in the OTC market, that is over-the-counter market in the International Financial Services Center, IFSC. In December 2022, the Reserve Bank had permitted resident entities to hedge their gold price risk in recognized exchanges in the IFSC. It has now been decided to allow resident entities to hedge the price of gold. Now let me just read it again. It has now been decided to also allow resident entities to hedge the price of gold in the OTC segment in the IFSC. This will provide more flexibility to resident entities in hedging their exposure to gold prices. The next announcement is actually very important and has far-reaching consequences. Particularly, it is something which will really benefit the small borrowers from the lending sector, from banks and other entities. At present, and that relates to key fact statement, that is KFS for retail and MSME loans and advances. At present, the loans and advances availed by borrowers, apart from including the rate of interest, also include other fees and charges such as the processing fees, documentation charges, etc. So as a result, what happens is that the customer, he knows that the loan carries an interest of so much percentage, but then there are other charges and fees, etc., which he pays upfront. Now that also needs to be loaded into the actual interest rate. So the customer has a clear idea that what is the actual annualized interest rate that he pays. And this is something on which, as you are aware, as I have said a little earlier, customer centricity is something on which the Reserve Bank lays a great emphasis in the overall public interest. Now, to enhance transparency in disclosure of such information, that is information on various charges, fees, etc., the Reserve Bank had mandated certain categories of lenders to provide the borrower a key fact statement, that is KFS, containing essential information such as all-inclusive annual percentage rate and recovery, and also details of the recovery and grievance redress mechanism. The requirement of the key fact statement is now being extended to cover all retail and MSME loans. This measure will lead to enhanced transparency in lending and will enable customers in making informed decisions. The circular will be issued separately. Obviously, we have to give some time to the banks to comply with these requirements because quite a few preparatory action needs to be taken at the end of the banks. The next announcement relates to enhancing the robustness of AEPS. Aadhaar-enabled payment systems, that is AEPS, has played an important role in financial inclusion by enabling customers to make digital payment transactions through service providers such as business correspondents. Given their significance, it is proposed to streamline the process for onboarding of AEPS service providers and introduce some additional fraud risk management measures. This measure will further strengthen the security of the AEPS system and enhance its robustness. The next announcement relates to principle-based framework for authentication of digital payment transactions. Over the years, the Reserve Bank has proactively facilitated introduction of various mechanisms such as additional factor of authentication for securing digital payments. While no particular mechanism was specified by the Reserve Bank, SMS-based OTP, that is one-time password, has become very popular. With technological advancements, however, alternative authentication mechanisms have emerged in recent years. Therefore, to facilitate adoption of alternative authentication mechanisms for enhancing the security of digital payments, it is proposed to put in place a principle-based framework for authentication of such transactions. The next and the final announcement, the last announcement, relates to introduction of programmability and offline functionality in central bank digital currency pilot projects. The CBDC, that is Central Bank Digital Currency Retail, the CBDC retail pilot currently enables person-to-person and person-to-merchant transactions. It is now proposed to enable additional functionalities of programmability and offline capability in CBDC retail payments. Programmability will facilitate transactions for specific or targeted purposes, while offline functionality will enable these transactions in areas with poor or limited internet connectivity. I now propose to conclude. The Indian economy is making confident progress on a strong, sustained and transformative growth path. Domestic and international investors are reposing greater confidence on India's economic prospects. In our assessment, the current setting of monetary policy is moving in the right direction, with growth holding firm and inflation trending down to the target. Therefore, much has been achieved, but we must remain vigilant. Policy making during uncertain times has to be based on a continuous assessment of the incoming data and its implications for the evolving outlook. We reaffirm our commitment to bring down inflation to the target of 4% in a timely and sustainable manner. Price and financial stability are the foundations for strong, sustainable and inclusive growth. Our endeavor all along has been to take a holistic approach to keep the economy in balance. We must not only preserve the hard-earned strength and stability of the Indian economy, but also build on this further for a long haul of higher growth with price and financial stability. In the current environment, what Mahatma Gandhi said long ago remains very relevant, and I quote, "I am moving cautiously, watching myself at every step." I repeat, I am moving cautiously, watching myself at every step. But there is the fixed determination behind every act of mine. Thank you. Namaskar.
Well, that's the policy. And before we go to our guests, a quick summation from me and Samina. What stood out for me, no change in stance to my mind. That's the headline. CPI inflation seen at 5.4% for FY25, 4.5% in FY25, and mentioning that the job is not finished because need to be vigilant on new supply shocks. And, well, interestingly, large mention on debt sustainability for the world at large and how it could become a new source of stress for the world. I mean, in an EM central bank talking about the message for the world. And real GDP growth, 7.3% FY24, 7% FY25, which would make it the fourth consecutive year of growth of 7% or above.
Right. And also, Neeraj, they were pretty explicit in stating that they are managing liquidity in a pseudo manner any which way. So after September, and that's what the governor indicated, that system liquidity had turned into a deficit after a 4.5-year gap, which we've actually seen and witnessed over the last couple of months. But after adjusting for government cash balances, potential liquidity in the banking system is still in a surplus. And that's what the governor said. They've also said they're nimble-footed and they will manage liquidity with repo and reverse repo. So the pseudo balancing of liquidity still remains the only way to manage liquidity. Their growth targets have, of course, been in line with what the NSO has said. FY25, the estimate is 7%. For FY24 stands at 7.3%. Inflation, I'll just quickly break those numbers down for you so you have some perspective on what it is. But of course, inflation as well is an unfinished task, is what the governor said. Neeraj Gambhir, Group Executive Treasury Markets of Axis Bank, and M. Kamakodi, CEO, City Union Bank, joins in. Neeraj, I'll start with you first. Are you surprised? No change in policy, no change in stance, and no major announcements on managing liquidity either. What did you make of these comments? In line, you think, or there's a little bit of surprise because while they talked about managing liquidity, they've largely said that they've been doing it and they're nimble-footed and will do what it takes when it takes.
Thanks for having me on the show. I think it's broadly on the expected lines, both on growth and inflation. In fact, I was a little bit positively surprised by the sort of assurance or, in some senses, the confidence that the RBI governor has on 7% growth for next year. Our own estimates are for a little lower, say about 6.5%. Nevertheless, it still continues to be it will most likely be another year of very strong, economic growth. And hence the sort of, I would say, reflection on the fact as to how fast you need to adjust rates. On liquidity, yes, we have seen Reserve Bank pretty active in the markets. We have seen over the last week itself multiple, repo and reverse repo auctions being done to make sure that the system liquidity stays. What the governor has said is not a new information. We all know that there is a very large government balance that sits there, which is causing this frictional liquidity in the banking system. The challenge is that this frictional liquidity shortage in the banking system is causing the short-term rates to actually spike up quite sharply. We've seen 3-month CD rates go up to as high as 7.8%, and that is obviously impacting then the cost of funds for the banks. So I think I'm hoping that with this renewed set of assurances that the governor has given, there will be some cooling off of these short-term rates. And I think he pointed out towards the fact that there has been some volatility in the short-term money market rates. So I think that's the key thing. If the overnight rates settle towards 6.5% and the short-term money market rates start cooling down, then I think this policy would have achieved what we would have liked to see in the policy.
Mr. Kamakodi, did no change in stance surprise you, or are you in sync with what Neeraj Gambhir just mentioned?
Yeah, just to add what Mr. Gambhir said, you also heard a statement which clearly said that probably from the earlier, policy announcements and all, you had more discussion on the Arjuna's eye on the inflation. And now it has been clearly spelled that, the things will be now, economy will be now getting ready for the growth, that all sort of, other actions will start and all. So it is definitely a little bit, we are positively surprised that probably happening 2 months earlier. Probably we were expecting this maybe in the next policy, but good that the support for growth will be more from where we are now. That's positive point here. All other on rates and all are like say on expected line.
Neeraj, I know while we are focusing on a whole bunch of global cues and the fisc and the budget and the market borrowing, but the fact still remains that we will, or we have, and we should be taking a cue from what the Federal Reserve does. The fact that that market rate cut expectation has now been pushed forward, do you feel like until the Fed moves, the RBI, even if conditions are conducive, will be unable to move because the rate differential is very critical for an emerging market like us?
Yes, it is, and hence what the Fed does is also of quite a bit of importance. Rate cut expectations in US have been pushed back by at least 6 months. I think the market was hoping to have it in the first quarter in March policy. Now we are looking at May, June, and even probably later, given the recent spate of data that we've seen in US. So yes, that does make the bar for a rate cut to move higher in India particularly. And also the fact that our growth continues to be strong. The task on inflation front is still not complete. We are likely to see a inflation outcome for this fiscal and the next fiscal, which is going to be higher than the target of 4%, basically means that Reserve Bank has no real hurry or a reason to cut rates anytime soon. And I think both of these factors need to be taken into account simultaneously.
Neeraj, that brings me to the next question, which is a little bit of a conundrum in my head at least. So core inflation has been easing in line with what the governor or the RBI would like, recorded at 3.8%. The fact remains that if it continues to fall and gets closer to 2%, this becomes bad for the economy. On the other hand, and of course because of that, the headline inflation has also cooled off. But vegetable inflation continues to be a sore point. Non-vegetable inflation has also been going up over the last 4 years. So what do you think, in your opinion, needs to be done to tackle inflation in that sense? Because you can't, and the only thing the RBI can really tackle is core inflation. But we don't want that to fall off too easily, right?
But at the same time, if the headline inflation continues to stay high and volatile, and remember, food is a large part of India's consumption basket, so can't ignore it that easily. And if the food prices continue to stay volatile, it affects people's expectations about the future inflation, and hence, it is not very easy for a central bank like India, where headline inflation is the target, to start cutting rates when the overall inflation or the headline inflation is much beyond the target. So I think Reserve Bank can take comfort from the fact that the core inflation is low, and hence, it is not a situation of overheating in the economy. It is more of a supply side issue in the vegetable and food basket of products, but cannot really start cutting rates till such time the overall headline inflation starts cooling off, trends.
By the way, just take a quick detour and mark risk assets by and large before we get in Anubhuti, Sahay in the conversation as well. The Nifty, the bank Nifty, both are off. I mean, we have seen the PSU banks come off because there was a bit of a rally. But let's just mark the markets about, not too much, but a bit lower. But the banks, and the PSU banks in particular, would be the ones. The bank Nifty is in the green, but the PSU banks have certainly come off. So that is to be kept in mind. A PSU bank index actually by and large okay. A few banks have certainly come off. Anubhuti Sahay of Standard Chartered Bank joins us right now on the show as well. Anubhuti, good having you. Thanks for joining in. Anything surprised you? I mean, one reference being made to external shocks in a meaningful way, particularly the debt that the developed world stands in, and how that is a source of potential future shocks.
Yeah, sure. I think there were 2 points which were of great interest. One, for the first time, we have seen a dissenter emerging and probably voting for a cut. This we have not seen, and our sense is, while there was just one vote in this particular meet, as we move further into 2024 and probably by June of 2024, we are likely to see 6 out of 6 votes in favor of cut. A fair bit of caution today, well justified, where the world stands today with the tensions in Middle East, and especially with the data surprising on the higher side in the US economy, and probably rate cuts been deferred there. So fair bit of cautiousness, which was a surprise, but the dissent for a cut was an equal surprise to us. Otherwise, broader on the policy decision, more or less in line with expectation. On your point about public debt to GDP, I think it's a very important point which the governor brought to the attention of the market. If we talk about the global level, there is a very high level of public debt. While it can be managed without impacting the markets a lot, especially if we look at the developed developed markets, it becomes a constraining factor for a lot of emerging economies, including India. And in case of India, while we all have applauded the budget, I think the public debt to GDP is something which is a factor on the minds of policymakers, and to a great extent, there is a great deal of focus to bring it down as soon as possible to ensure that the issue with the rating agencies about high public debt to GDP gets addressed sooner rather than later.
Okay. Mr. Kamakodi, small things, but he mentioned about how 2 or 3 very important moves taken at the end of, virtually at the end of the policy, including allowing resident entities to hedge price of gold, extending KFS requirements for all retail and MSME loans because it's mandated earlier only for certain class of lenders. Any thoughts on those 3 or 4 announcements that were made?
Yeah, particularly on the, key factor statement is there for some time, but including all charges with the interest rate, let's say it will, we have to think over that, and probably some amount of saving on the GST will also be there, because if it is included in the, let's say, interest rate, if it is a charge, you have GST over and above that, and if it is in the included in the interest, you don't have the, let's say, GST part on that. Some amount of, let's say, thought should be put over there to take it forward, but it will be definitely, let's say, beneficial to the customers, and overall transparency will be getting better and better.
Right, we also have with us Keki Mistry, former VC and CEO of HDFC Bank, joining in. Hi, Mr. Mistry. Thank you very much for taking the time to talk to us this morning. No surprises on policy, not too much of a change in the tone or the stance. More or less on expected lines, or would you have expected or liked a slight change in stance, commentary maybe? He hasn't even said much on liquidity in that case.
I don't think I would have expected too much of a change, given the fact that the external environment continues to remain uncertain. Like you've seen that, you have 3 wars going on, 2 wars going on, and 1 near war going on. You have this Gaza issue, you have the Ukraine-Russia issue, you have this, conflict between US and Iran. So in that kind of an environment, things can be very uncertain. You could have a sudden change in oil prices, sudden change in sentiment. So given all of that, I think RBI will continue to be watchful. My sense is by the time we come to, let's say, May or so, around May, RBI will get a better fix on where they expect the monsoons to be, and whether we expect a normal monsoon and therefore normal, agricultural output, and then maybe act in terms of lowering interest rates. But I still believe that once the macro environment stabilizes, and if we don't have any surprises on the monsoon front, we could look at a rate cut coming sometime in maybe even in May, June.
Mr. Mistry, good morning. Neeraj here. Just wondering, did the confidence of the Reserve Bank of India on growth surprise you precisely for the reasons that you mentioned, with the conflicts going in and world growth slightly looking dodgy? Is 7% number that the Reserve Bank has said, did that surprise you?
No, not at all. If you ask me personally, and I've said this before also, in my view, a growth may even be slightly higher than 7%. We are not that much dependent on global factors as the rest of the world, in the sense that our economy is largely a domestic economy, and as long as we are creating jobs, people have jobs, they have income, they are spending money, consumption is there, manufacturers are incentivized to produce more. Because they are producing more, they're hiring more people. So the economy is on a roll. And there's a multiplier effect to these things. So I'm not at all surprised. In fact, I would believe, in my opinion, that we would end up with a number higher than 7.
Okay. Mr. Mistry, appreciate that. Thank you so much for taking the time out and being with us. Really appreciate your time. My colleague Vishwanath Nair is now standing by with the key highlights of the policy and what stood out for him. Vishy.
Right, Neeraj. So we expected a dovish sort of policy, but then, of course, the RBI governor came in and delivered a slightly more hawkish tone in his commentary. Now, of course, the point that we have to watch out for is that sixth policy again, status quo. The stance remains the same as withdrawal of accommodation. But the RBI governor's main point is that there is a lack of transmission. There is an incomplete transmission happening in the credit market, for which reasons he didn't explain during his speech. Maybe later in the press conference he will explain it. And the other main point is that the inflation is still away from the 4% target. So those two things are the most important driving factors of what future decision making on the monetary policy front are going to be. Now, if you look at where the RBI is projecting inflation for this financial year as well as the next financial year, FY25 is expected to be around 4.5%. Inflation hits 4% at some point in September, and then later on in the following 2 quarters of the next financial year, you will still see inflation remain higher than the 4% target. So that's something that you need to watch out for, and how that influences the RBI and the MPC's decision making. Liquidity front, I heard Samina say that they didn't make any clear announcements on liquidity. That's true. They didn't, but what the RBI did say is that they will continue to do two-way sort of moves, which is infusing liquidity when needed and absorbing excess liquidity whenever the situation warrants it. So the RBI remains nimble as far as managing the system liquidity is concerned. On the growth front, the target of about 7% for FY25 sounds of a very, very strong sort of growth momentum. The RBI governor has said that the strong growth momentum we saw in FY24 is likely to continue next year. Now, apart from all of these rate-related decisions, I think two important things that the RBI governor did talk about. One was on the key fact statement bit, which till this point in time was only on for digital lenders who need to issue a key fact statement to the customers, which details all the interest rate as well as other costs involved with a loan. So now that will be extended to all retail and MSME loans. This is intended to bring in more transparency, but of course this raises the compliance costs for banks and NBFCs who traditionally did not do digital lending. The other important bit is on the CBDC front. The RBI is proposing to bring in additional programmability. Now, to my mind, that's a bit of a dicey area, because the whole intent of bringing in e-rupee or CBDC is to make digital rupee the equivalent of paper currency. Now, if you bring in additional programmability, which is to say that this money can only be used for a specific purpose, if you bring in that kind of programmability, then you take away from that fungibility factor of the paper currency, and that takes it away from the commonality between digital rupee as well as the paper rupee. These, to my mind, were the most important sort of factors to watch out for as far as the monetary policy announcement is concerned. Let's see what happens during the press conference. Specifically, I would really like to know what the RBI governor meant by incomplete transmission and what the factors behind those are.
Right. Thank you, Rishi, for that. Of course, Gus, you've got to run for the press conference, but we will catch you soon again. Neeraj, explain this to me, and we're a little perplexed at this stage. There was really nothing too exciting in that sense in terms of the policy, and I'm not saying that's a bad thing. No change in policy, not the governor not sounding dovish at all, in fact highlighting global concerns that could play or could be the jack in the pack. Why, I don't know if you've got a cue on this, and I know equity price is just one part of it, but PSU banks specifically are having a field day this morning. What are they getting excited about? Anything that you found that we haven't managed to catch?
No, nothing. I haven't really caught on to anything which I think should have a particularly impact on PSU bank shares. Could be one of those days when the market is just kind of looking at a particular segment. But in the policy per se, I did not see anything which has a positive or a negative bias for a particular set of banks.
Anubhuti, I want to come to you now. You did say that you're largely in line with what was expected, but anything more that you'd have liked to see in terms of commentary? There were some parts of the markets expecting maybe a slightly more dovish commentary, which in my opinion hasn't happened. And also with liquidity per se, the governor has maintained that they are nimble-footed. They will do what it takes when it takes. Nothing too detailed in terms of liquidity management. Were you a little disappointed on that front?
On liquidity, I won't say that there were disappointments. Market always expects very explicit guidance or very strong measures when it comes to liquidity management in every single policy meet. But if you go, barring the ICRR announcement, which happened in the August policy decision, otherwise, very strong statements of liquidity have never, are usually not made during the policy days. They are made out of the policy days. So I don't think I would say that I'm disappointed to say so. Whatever is required, I think RBI will continue to do on the way they have been doing it for the past several weeks. On your point about dovishness versus hawkishness, yes, we expected a little bit more acknowledgement on the way domestic inflation has panned out, especially given where core inflation is. And in fact, if we just step back and look at some of the comments which were made by the governor earlier in the year at Davos, his first interview where he sounded a lot more positive about the domestic inflation trajectory. That was missing in this policy statement. So our sense is this is primarily driven not by some fresh development between Jan and Feb in the Indian economy, but probably is weighed down more by what's happening globally. As I mentioned earlier, Middle East tension needs to be watched out because it has a lot of implication for oil prices. And also, if you look at the U.S. economy and the pushback which the market in general has got on rate cut expectations from March to May, I think these are very important factors which any emerging central bank governor will have to take into account. So more cautiousness is primarily driven by global factors, in my view, rather than anything changing on the negative side domestically.
Got it. Anubhuti, Neeraj, Gambhir, lovely talking to you, both of you. Thank you so much for taking the time out and being with us. Mr. Kamakodi, I have one final question for you, and that is around whether the policy statement in some sense leads anything about growth for the banking sector, because there are a lot of question marks around credit deposit ratio any which ways and the extent of private capex and what it would do to growth per se.
See, even though you don't hear anything very specific or very pointed, the general message that what I slightly different from my previous speakers, in the sense that now the period of focusing on the inflation targeting, there are multiple statements, but directionally things are cooling up, so eventually at least the light at the end of the tunnel is visible, and going forward you will be sooner than later you will start seeing the interest rate coming down, which should propel growth. And there was a specific statement which I could hear which said something like from inflation targeting, now we are we'll start focusing how to support growth and something like that. So things have to, we should be getting for better days to come.
Better days to come. Mr. Kamakodi, I'd love to talk to you longer, but we're sadly out of time this morning. In the meantime, so thank you very much for joining us. But in the meantime, the markets are almost holding steady. Banks are having a great day. I guess it's a trading day for PSU banks. Nifty is actually inch lower, so my bad.
Nifty, private banks are down, but PSU banks are doing well.
Private banks are lower. The Nifty itself is off. PSU banks, stocks like SBI, are looking exceptionally well placed in trade as we speak. Even PSU banks has come off just a little bit in the last couple of minutes. SBI trades the gain of 4%. But what is catching our attention is LIC has taken its peers along higher this morning. LIC trades with a gain of 8%. The New India Assurance is up 11.5%. General Insurance, GIC, is also trading with a massive gain of about 12%, turning out to be one of the top gainers on the Nifty 500. So those counters, again, catching our attention. Neeraj, I'm not sure whether this is just pure trade or there is
also the data
more
that came out maybe late hour yesterday.
Data, what the Prime Minister said, and LIC earnings. I guess there are three good enough reasons for the insurance pack to trade firm. With that, completely out of time, but thanks for joining. There's a lot more programming on the other side, so stay tuned.